So good morning and good afternoon. It's good to have you join this fireside chat with us and our great speakers, Paul and Karen. I saw Karen post news about ClimateTech companies just had their best quarter for fundraising in almost 2 years. 16 billion,
Yeah,
but
16 billion on this quarter, Q3.
yeah. VC investment into ClimateTech is doubling, like YOY, but the funding gap is not closing fast enough. So part of the motivation of doing this topic is that most people think climate tech investment are capital intensive deals. They will not touch climate tech startup because they think there's not their cup of tea. Are they really all capex heavy? One of the questions we will ask startup is, what's your capitalization plan? It will impact life or death, speed of growth, capital efficiency for startups and returns for investors. We want to know what kind of capitalization and financing strategy in what stage makes sense for climate tech startups, and what kind of funding gaps, risk are there, and possible funding sources. Non-dilutive funding options, what are happening differently now compared with the previous clean tech 1.0 era. And our speakers will talk about rule of thumbs, big picture, because today we only have 30 minutes and to cover about 3 parts of the topics. So lady first, Karen. Karen is the founder and managing partner of Pachamama Ventures, a VC firm investing in US early stage climate companies. She's also a finance director at Visa and has previously worked for Pepsi and American Airlines. So welcome, Karen. Please share with us about your passion about climate startups.
Yeah, thank you, Jesse. I appreciate the introduction. Yeah, just briefly, right? Like a lot of people's questions have to do with like why climate, right? And so I am originally from Peru myself, and so I grew up in a part of the world where it was like really impacting every decision you would make, from how you commute to what kinds of foods you can eat during that week, believe it or not, and public health, right? Like I grew up with asthma, and I remember just there was a couple of times where like it got really bad that I had to go and be rushed into the ER because of the pollution, right? Like in living in a place like Lima with 12 million people, and just like the impacts of climate and smog and whatnot. But and also my own father was an agronomist, so he was actually working for a German agtech company at the time, and his clients were farmers, right? Like so helping them like really regenerate and make the best use of oil soils in a way that doesn't degrade them. And so that's kind of like the backdrop of why I switched to climate and made it my whole thesis to invest out of fun. And it's, as Jesse mentioned, early stage. But I'm happy to be here. Thank you so much for the invitation.
Thank you. And Paul is an operation and investment professional that has invested over 3 billion in almost 100 companies. He has done CVC. Before CVC, this term becomes cool. And he also has been a clean tech startup CEO with an asset, and also the managing director of North America for a public clean tech company. Also, Paul, would you like to share about your current new venture, asset ventures? Investors and startups all like to hear about asset strategies.
Okay, sure. And thanks for having us on today, Jesse. This is going to be fun. I think it's going to be a great conversation. So I'm the general partner, one of the 2 general partners of Exit Ventures, and we are a sustainability, clean tech, and impact venture capital fund that focuses on late seed to Series B startups. And you know, we have because I've been a strategic acquirer, as you mentioned, I've invested in about $3 billion worth of businesses as a strategic. And so I use that expertise to screen the companies that we're looking at for those that are likely to be acquired by a strategic. And then we implement our strategic exit system, as we call it, after investment, and help these companies get corporate partnerships, strategic partnerships, and build value along the lines of a strategic exit, so that when the time comes, their chances are significantly higher and the value is significantly higher at exit. And so that's our focus at Exit Ventures. Been like you said, I've been a clean tech operating executive for several years, and it's my passion. Honestly, a lot of people say, hey, what can we do? What can we really do? Or the trends are not our friend. And after working in clean tech for a while, and after working with clean tech startups, I've never been more optimistic. I'm very passionate about this because I think the technology that's coming down the pipeline is very, very interesting. And I couldn't be more excited about the next decade, because I think the technologies that are being developed right now are going to be very, very impactful.
Thank you. So we see that Karen's focus is more on early stage climate startups, and Paul's focus is more on later. Mostly about A, B. So both can give us different perspective from earlier and a little bit later. So let's start with the first topic. Please share your big picture and advice on the funding gaps and sources for climate tech startups and projects. How about start with earlier stage, and please, Karen, start this topic.
Yeah. Do you mind flashing on the screen the one graph that has all the different fundings?
Yeah. Okay.
Yeah, that will be a good an excellent graph to talk to as I start with the pre-seed, and and then Paul will take it on the later stages.
Yeah, this one.
Yeah, that one, and then slide number 5. But then let's start with this one. This is pretty, oh, sorry. Yeah, let's start with this one. This is pretty good, actually. So you can see here, like the different for sources of funding, right? Like, I mean, the well-known ones. But if you think about a really early stage for climate tech companies and startups, they are needing funding first to do what, right? Like to develop a prototype of product, right? Like they will work. Depending on whether the company is actually a software or a hardware, let's assume that they are hardware data companies we're talking about here. So if you want to build your prototype, you're going to need different kinds of funding. And there are different kinds of fundings that are available to you. Really early to develop a prototype, you're going to probably need to start with like family, friends, angel groups that are like specifically geared towards climate only. And there are quite a few of those right out there. And I don't know, maybe we can send a list of resources at the end of the event or something, but like there are a number of angel groups that are exclusively investing in climate. People who are essentially really willing to bet on you from the very beginning, right? Like the types of people that will be willing to support you too, and why, like it will all vary. But like if you're a prior exited founder, or like you're a first time founder, those things inevitably, right, like factor in. But also like just the size of the market, right? Like what is it that you're trying to build? Is it a breakthrough innovation product, or a solution? And so all of that. Government comes a little bit later, after the first few funding mechanisms from family, friends, and angels, early angels. But government, there's a lot of money right now flowing around for early stage companies because of the signing of the IRA, because of a number of other initiatives. I highly recommend people, especially that are building deep tech companies in climate really early, to really get non-dilutive capital. And that's essentially what non-dilutive capital means, right? Essentially, any capital that will go to support the development of a solution without taking any equity from you, right? Which is the exact opposite from VC. So I think founders are pressed to really go and find out what's out there for them. And, like sometimes I'll get the response back to say, oh, it's so difficult to get a grant, or I don't even know where to start. And that's where I like to pair them up with grant writers in my network, or say, these grant writers that are specifically working on only climate, they will know what grants are out there that are applicable to your business once you get in a conversation with them. And the argument of getting a grant being difficult, I just say, if you think getting a grant is difficult, try getting VC funding when you don't have a prototype that is being proven, right? Like a concept or something that is working and is ready to be commercial. So I think that that's one of the biggest funding gaps right there, is how do you get to building the prototype and getting to become commercial, right? And so I would say early stages, focus on family, friends, angels, government grants to build out your solution so that you can de-risk it and make it more attractive to the VCs. And then once you start getting on the commercial side of things, then you'll get traction, right? Like you'll get more people interested. It's like hedgehog game. Like everyone starts like looking around and looking for you, because now you have like some proof of concept that is potentially getting maybe one client out there, right? So this is an interesting graphic. And then if we move on to was it the prior slide or the second slide with that one? So this is, I really love this. And by the way, this is the CTVC website, right? Like, so
Yeah,
if you,
yeah.
for those folks that are familiar, that's a website ripe and full of like amazing data
Yeah.
and articles on that. So, I was talking about grants, for example. Maybe what's not like, I think they're probably rolling it up under venture capital, but family, friends, angels, right? Like what that are very risk accepting will be in that category. And catalytic capital essentially refers to, if you think of like impact investing vehicles, or like investors that are like solely, maybe not solely, maybe solely is the wrong word, but like mostly focusing in investments because of the impact, and they are less concerned about whether it's going to be like an outsized return investment. Those are great options too. And then also philanthropic arms, like I just saw a news yesterday from the Rockefeller Foundation saying they're going to like divest to 11 billion, or I mean, I think it was $1 million. I don't think it will be a billion. That's a lot. But it was late at night. I mean, but like there are a lot of philanthropic arms of family offices and foundations that like to really invest in climate because they, really care about it, right? And the planet, and it's part of philanthropy in their mind. Um, and as well as what else am I leaving on out here? What I don't see necessarily here, or maybe falls under commercial debt, there are other ways to get also funding early on. Well, early on, it's post-revenue. There are revenue-based financing mechanisms and organizations like Enduring Planet, run by Dimitri. So Enduring Planet essentially funds people or companies, sorry, after they have some fund revenues in, and then it's a proportion of the revenues, right? Like at an extremely low or zero interest rate. And so that those are the venues. So I would say your most risk accepting is venture capital angels, and then you have also like grants and catalytic capital. I do love the expected return range IRR listed there, because it's essentially true, right? Like VCs, if you think about VCs, it's not so much arrogance, although some of my peers might be might be described as such. It's not so much arrogance that we look for like a 30% IRR minimum, right? If you think about it, we have like a number of LPs behind us backing us with their capital. So it's like it's a fiduciary duty essentially of investors to really ensure that these plays that we're investing in, like 10, 20 companies out of one fund, really have a strong shot, right? Like a goal. So that's where that comes from. But um yeah, so I'll leave it there and then let Paul take the baton for the later stage.
Okay, great. Jesse, if you want to go back to the previous slide just for a minute.
Sure.
So that slide coming up here.
Yeah.
That one. There we go. so this slide I think is great from the Maryland Energy Innovation Accelerator, because you see in the first commercial operation, you see this significant gap and fall off of traditional financing. And honestly, this is one reason why a lot of investors in the past have shied away from not only clean tech but hard tech investments, because they say, you're gonna hit a wall, and there's just that capital stack is not mature enough to help propel the startup through the entire commercialization phase, right? Like if you hit this brick wall here at the first commercial operation and capital is not available, your chances of making it through that valley of death, so to speak, are pretty low. And so in clean tech 1.0, as we call it, in the early 2000s, that climate capital stack was pretty immature and pretty thin. And so the good news is that now with clean tech, whether you want to call it 2.0 or 3.0, I see different opinions right now, but this problem is being solved by many different kinds of capital. You've got the DOE loan office, which is stepping in with a lot of money. You've got hard tech and clean tech funds now that are raising billions and tens of billions of dollars. You've got corporate venture capital groups that frankly didn't exist. Most of them didn't exist 5, 7, 8 years ago. And you've got customers that can now, in some cases, be a bridging gap where you can give a customer, most favored nations status and say, look, if you help fund our project, then we'll give you a 5-year contract with very preferred rate terms. And that's a win-win for the company. That's a win-win for the startup. And so there are a ton of options and this is what makes one of the things that I'm so optimistic about, is that gap here where you see the first commercial operation has actually narrowed. And I would say that this chart is probably more indicative of what the situation was 5 to 10 years ago. But I would argue that now that gap has narrowed pretty substantially. And we can talk about the DOE loan office, which works with commercialization stage projects. We can talk a little bit about CVC. We can talk a little bit about the different infrastructure funds. That's another option, is you have hard tech and clean tech infrastructure funds, growth funds from very large and well-respected asset allocators, as well as small to medium-sized infrastructure investment firms. Again, most of these did not exist 5, 6, 7, 8 years ago. And so the climate capital stack has been developing rapidly. And I think that it's great news. And I think this gap that you see here under first commercial operation is narrowed pretty substantially.
Yeah. I think you already covered into our second part of topic is about partnership with clients. Also, you mentioned CVC, and of course, this kind of partnership will impact business model. So, could you more clarify on partnership strategy and business model, and that also related to exit strategy, right? With the end in mind.
Yeah. So at Exit Ventures, we definitely work with the end in mind, and this capital stack and financing strategy is very important to make sure that our startups and our portfolio have the runway to be able to get to that exit. So I mentioned customer financing, and I would argue that startups maybe are not as creative as they should be or can be in some cases in utilizing a valued partnership with a customer in working with them to finance some of their needs. And it may not be all of it, but a customer financing can be very interesting and very beneficial. CVC groups there are now consultants going around to corporations saying, we can help you set up a CVC group, and we can actually run part of your CVC group. And then, you kind of take it over time, or, they hold the hands of the large corporate entity until the CVC group is mature. And so with that help, the number of CVC groups has really exploded in the last 5 or 6 years. If you're a clean tech, let's just say in recycling, for example, if you're a clean tech startup, there are a lot of different recycling companies and consumer goods companies that use plastic, for example, who are really looking for strong technological solutions. And so the number of CVC groups available to you, if you just look at the corporates that are involved in your industry, is really pretty large, pretty deep, and it's growing every day. So I would argue that that's a very good source, because then you've got a partner who's the likely acquirer, right? And that's what you want. You want that partner who's vested in your success, who can give you that likely exit a few years down the road once you're successful. And then I just quickly mention the DOE loan program. It's called Title 17, and you can look that up on the internet. It's a great program. It's for commercialization of clean technology. You need to have at least a technical ready level 6, which basically means that demonstration and pilot information has to be available. It can't be used for R&D. This has to be, data has to be available. Demonstration pilot data has to be available. And if you fit these criteria, then 50 to 70% of eligible project costs can be covered. Loans can go as long as 30 years. So this is not a grant, it's a loan, but very low interest rates, loans up to 30 years for easy repayment. And this has been funded repeatedly over the last few years through the IRA and infrastructure bill. Here's a little chart you can see on the screen with some of the criteria that you need. This is on DOE's website. So we don't have time to go into a lot of detail, but take a look at just do a Google search on DOE Title 17 loan program, and there's a lot of great information there. Jesse, do you want me to touch on the exit question, or do you want to go a little bit more into detail on some of the financing options?
Yeah, I know Paul can talk about maybe 1 hour about exit strategy. Thank you for writing a lot about this exit strategy. But maybe Karen can share a little bit about the previous topic about partnership and business model.
Yeah, absolutely. I mean, as I'll say, Paul's got ahead of me too on talking on the CVCs, because I totally agree with him, right? I think CVCs, well, like I have 15 years of experience as a finance professional operator in Fortune 100 companies. So I have seen that interest and that increase. Like CVC was not a thing, right? Like maybe when I started my career, I wouldn't see a lot of Fortune 100s talking about CVCs who were like the cool kid in the company, like hobnobbing with Silicon Valley people, like they are now, right? Like so, the PepsiCo corporate had a corporate ventures team. Visa has one for sure. That one invests only in fintech, and the one thing there are pros and cons going with CVC, right? Like so, the pros are like very obvious, right? Like you get a partner like Paul mentioned that helps you along the way. They are invested, or like really a strong partner in developing and proving out the solution, and making it more commercial, and really making the use cases more broad, right? Like for that industry. And then obviously they a lot of times end up becoming the acquirer, which is great, like to have like a path to exit that way. I would say the one con maybe that I sometimes I find, and I talk to people and founders like tell me about their experiences in the past. They're like, just be mindful that that company is probably going to want to take a certain direction, but that's no different than any other investor for that matter, right? Like a large investor is going to come in and have like a board seat, right, in your company, and is going to want to make sure that the company is going in a certain direction. So as you take investment, just be mindful of that. And with CVCs, that's very true because they have to make sure that the partnership is a commercially viable partnership for the company, the larger company, right? And obviously, then there are issues with integration, making sure that M&A works well, like all of the fun stuff, right? Which is not fun, I mean, it's realistic. But so I will say that about CVCs, they are increasing their footprint and in presence with innovation and really putting money very early into climate tech startups. There is an example I always like to talk about, like is BAS VC, who show me what essentially they invest in, and this is the chemical company, right? The German chemical company. And in my mind, I was thinking, oh, well, he's going to show me everything that is in the chemical space that they invest in from their CVC arm. And no, he's like, oh, no, we invest in space exploration, climate tech, some even consumer. I'm like, what? Like the CVC just got so big, right, over there, like, and they have a lot of money to play with. And one of his biggest concerns or things that he was mentioning is a lot of the deals that we see are a little way too early for us. So I end up with like 80% of my desk that is a little too early for VASF. And then I need partners at the early stage that can actually help me validate those deals that are great deals, but like, and also invest right along the way. But so that's on CVCs. I'll say on commercial partnerships above and beyond that, I've seen also an increase, and I see that at Visa, I see that at PepsiCo when I was there, with like the CSO office, the Chief of Sustainability Office within Fortune 100 companies. They are like really scouting commercial partnerships with climate tech startups too. So that is a trend that is going to continue over time. There's many articles that have come out recently on the role of the CSO at big companies and like really starting to sound the bells and making it less about just ESG compliance, which we don't want that. We want to move away into more aggressive territory and making real impact in climate. But I'm seeing that trend too, and so that's what I would say about like the two trends that I'm seeing from Fortune
Yeah,
100 and large organizations.
thank you so much. So the last topic is about ethics, when and how. So maybe Paul, you can, I know we don't have enough time, but just touch and point us to the direction about how to think about this, and maybe your content. Also, your writing on our drug, I will put up in this events writing.
Yeah, I'm happy to talk, after this. If anyone has specific questions, you can hit me up on LinkedIn or elsewhere. But just really quickly on exits, how, the how and how to think about exits. I mean, very briefly, the founders and the investors, first of all, need to think about, do we have our required return yet? And it may not be time for if you have the option for an exit, you need to think, does everybody kind of hit their required return metrics? And it might be too early and you may not be, in which case it may not be the right time to sell. There's no easy answer, because I've heard a lot of stories from people who said, we sold too early and the technology was, after we sold, really hit the mainstream, and we probably left 50% of the purchase price on the table by selling too early. And I've literally heard the exact same opposite, where people said we were stretching and thinking we could go, to an IPO or get a $1 billion unicorn valuation, and something happened and the market fell out from underneath them and they got very little, right? So there's no easy answer, but you need to talk about your return as founders, as leadership, the investors' required return. If you have a realistic exit opportunity, right? I mean, I would err on if a corporate comes to you or an investor with something that's reasonably attractive, I would generally err on the side of taking it, right? Don't be greedy. My advice is just my opinion. Other people have different opinions. Is to say, if it meets most of your expectations, of your investors' expectations, take the win, take some money off the table, and then go do something else, and go for the second at bat and the third at bat, and keep going. But take the win, get that wind underneath your belt, and it feels good. It's great for your career, and it's great for the technology to be passed on to a new home and a new environment where it can be developed. And that's frankly, hopefully, one of the main reasons that you're doing a startup to begin with. I do half-hour to hour-long presentations on how and when to exit. I can talk offline as much as people want to talk about that, but given the time constraint, we'll just leave it at that for now, and people can hit me up on LinkedIn afterwards.
Yeah, definitely. Actually, I can stay, and if any speakers or participants want to stay to ask questions, just feel free. We will open the floor now.
I can stay on too.
Yeah, I can stay for a few minutes.
So if you have questions you'd like to ask, just unmute yourself. And at the same time, just to share that next week we are going to talk about techno-economics analysis for climate tech, how climate tech can be adopted. Maybe in other area we talk about unit economics. In climate tech we might talk about for example, hydrogen need to have cost lower than $1 per kilogram, but there is much more complicated.
That's a very important topic.
Factors.
Yeah, that's a very important topic, the techno-economic analysis for climate tech.
It's very complex, and a lot of factors need to be considered in order for new climate tech to be adopted by clients or partners. Integration planning. So that's next week's topic. So yeah.
Hey Jesse, I'd like to ask a quick question.
Sure.
So reading and sort of understanding a little bit where Clean Tech 1.0 and where we are currently, like with 2.0 or 3.0. Like one of the big issues on the financing side has been sort of the like this asset medium stage, or projects that sort of lay within the 5 million or 10 million to about 100 million range, and sort of the funding gap, the scale. Like obviously that visual from the Maryland like accelerator kind of like depicts that like as well. And it's been covered by like a couple of foundational partners within the climate deep tech space. What is this more of maybe not having the right players in the space, noting that now large infrastructure funds are potentially looking to, play a bigger role? Is their involvement needed more to be able to properly scale some of these ventures? Yeah, like would love to get like any viewpoint on that.
Paul, do you
Karen,
want to take first, or?
Sure. So the question is do the infrastructure funds need to reach down to smaller projects? Then is that the question? Or
either or, like is it where these startups and VC firms need to sort of propel and kind of open doors into that world, or is it the other way? Yeah, like either or, like from either viewpoint.
Yeah, I think it's both. I think you've got to have VC firms come up the stack. You've got to have infrastructure funds come down the stack, and I'm seeing that. I mean that is happening. Maybe not as much as we would prefer, and I think that first commercialization stage is still the weakest spot of the capital stack, right? That is still, it's always been the problem. It's the most problematic now. There's more options now than we've had in the past. There are a large number of clean tech funds that have started in the last few years that are not just seed. A bunch of them are seed, but a lot of them are kind of, Series A, like I am, Series B. And we're trying to solve that problem. Like that's literally what we're trying to solve is that problem. But I think there's a ton of infrastructure funds that are doing the same thing. They're starting to come down to a smaller range where they don't require a $50 to $100 million project to get through the door.
You know, and like that's a great point. Like on the early stage, like there does, at least to me at least, seem to be quite a bit of a boom on the whole early stage climate, like VCs, like taking part, but we don't see enough in the later stages, and like that's where that's where economics sort of draws like its strong point, and where, other players possibly venture in to play in that space.
Yeah, and look, we're working with two investments right now. One is a plastic replacement, and that's I think it's going to knock the park out of single-use plastic, products. It's very exciting. That's going to require some capital, but not as much as you might think. Honestly, it's not a massive, capital requirement. Same thing with long duration energy storage for solar and wind and industrial use. We're working with a very disruptive startup right now that, in my opinion, is going to significantly disrupt lithium as kind of the go-to long duration, because lithium's not long duration, but now we have, I think, in the very near future, a very viable long duration energy storage alternative that we've never had before. We're working on that, and I think within a few years you're going to start to see some fireworks there. So, and then again, that's not a massively capital intensive solution, and it's not a mining solution, right? And so capital intensity, I think technology, one of the things that I really like is technology is helping us reduce the capital intensity to some degree, not entirely, and I don't want to be, naive about this, but in my opinion, the capital intensity is coming down somewhat, and that's also helping.